The last few weeks have felt broken, markets wobbling, crypto selling off, headlines screaming about liquidity, and everyone arguing about whether this is the start of a brutal bear market. At the same time, the Fed has finally pulled the trigger and ended quantitative tightening as of December 1st, and an interest rate cut on December 10th is looking more and more like the base case. What if this is exactly the path Cathie Wood laid out weeks ago? In this video, we are going to break down 3 parts of her latest Ark webinar, recorded on November 14th. First, why she thought the liquidity squeeze would be temporary. Second, what the underlying economy is really telling us about growth and inflation. And finally, how Ark has updated its long-term Bitcoin framework without backing away from its big bullish thesis. As always, this is not financial advice, just a breakdown to help you understand how one of the most famous growth investors is connecting macro and Bitcoin. Let's start with the squeeze everyone is feeling right now. Before we play the first clip, remember the timing. When Cathie recorded this, the Fed had not yet ended QT. Markets were still arguing about the next move, and the government shutdown had just jammed up the Treasury general account. From her point of view, we were in the middle of a liquidity crunch that felt awful in the moment, but she believed it was already on a path to resolve. But before we continue, a quick word from our sponsor. Crypto is evolving fast, and it's never been easier to be part of it. Introducing Crypto.com, the all-in-one platform trusted by over 100 million users worldwide. Buy, trade, stake, and spend more than 400 cryptocurrencies in one easy-to-use app. Enjoy zero trading fees on select tiers, up to 6% back on your Crypto.com Visa card. Fund your account in your local currency, withdraw to your bank, or spend anywhere Visa is accepted, all in seconds. With bank-level security and a track record of trust, Crypto.com gives you the confidence to grow your portfolio safely. Crypto.com isn't just another exchange. It's where simplicity meets opportunity. Download the Crypto.com app today and experience the future of crypto. All right, let's get back to the video.
We are in a bit of a liquidity squeeze. We think it's temporary. There are 3 reasons. One, we've seen the Fed, as of the last meeting, not end quantitative tightening. Many people expected them to do it at the last meeting. We think they will do it at the next meeting, so that's December 10th. The second liquidity squeeze is related, and hopefully we can say now was related, to the Treasury general account. When the government was shut down, the Treasury's cash balances were building. They were not dispersing the cash. The government shutdown is over. It's going to take a little bit of time to ramp and get everything back to normal. But we think that source of a liquidity squeeze is behind us. And now we're dealing with the third, and it really has to do with interest rates. Will they continue to come down? The market had been thinking, yes, they would, and we'd get another cut in December. We think we will get another cut in December, and that the Fed will shift from what seems to be a hawkish tone right now back into a more dovish tone as we approach that date. We're seeing inflation really come down significantly. Maybe we don't have the government statistics, but we do have the bond market, which is helping us understand that as measured by the 10-year Treasury yield, the inflation expectations have been coming down for the last few months. We're in roughly the 2.5% range on that metric. Same is true for trueflation, which is a real-time indicator, 10,000 items monitored, tens of thousands, I think it is, monitored in real time. And that metric is at roughly 2.5%. Now, it was down to roughly 1.5%, has come up here. Tariffs, of course, are a big reason. We think tariffs are going to wash through as well, and some may even come down.
So Cathie is basically saying there are 3 moving parts behind this squeeze. First, the Fed kept QT running longer than many people expected. That pulled liquidity out of the system and kept financial conditions tight, even as inflation was drifting lower. Her call was that QT would end at the very next meeting. Second, the Treasury general account blew out because of the government shutdown. The government was not spending as usual, cash balances were building, and that sucked liquidity out of markets in the short term. That is a plumbing issue, not a structural problem. Third, the rates market had started to price lower yields and more cuts, but the Fed was still talking tough. Her base case was another cut in December, and a shift back toward a more dovish tone as the data kept softening. Now fast forward to where we are today. QT has already ended, the TGA spike from the shutdown is behind us, and the probability of a December 10th cut has moved from maybe to this is what the market expects unless something breaks in the other direction. In other words, the path she mapped out from squeeze to easing is already in motion. But none of this matters for Bitcoin unless the real economy is also changing. That is what she tackles next. On the surface, the economy still looks fine. GDP prints have not collapsed, the unemployment rate is not at crisis levels, and you can still find headlines arguing that the consumer is strong. Underneath, the story looks very different. In the next clip, Cathie walks through 3 things she thinks the Fed is underestimating: weakening employment, slowing velocity of money, and what that means for nominal GDP and inflation over the next year. Listen carefully to how she links those pieces together.
Inflation could come down significantly in the next year, but it has been stuck for the last year in that 2.5% range, give or take a little. So we think it will resolve on the low side of expectations. We're surprised at what the Fed is saying right now, the various Fed governors, especially because the employment indicators are weakening significantly. Sure, we don't have the government employment indicators, but ADP is out, and month after month now, they are saying that employment is either contracting or expanding very, very slowly. And we're also seeing new graduates. That unemployment rate is increasing more rapidly than any other cohort's unemployment rate. And I think the duration of unemployment for everyone is approaching 30 weeks. So these are indicators that suggest that the velocity of money it has already flattened out, and we think it will go down on a year-over-year basis. M2 right now is up 4.8%. If the velocity of money falls on a year-over-year basis, that means nominal GDP will probably drop below 4% or 3%. And nominal GDP includes both real GDP and inflation. So the combination at 3%, something's going to give. And right now, it seems like the real side of the economy is starting to capitulate, as measured by labor, at least. As productivity increases, maybe it won't hit the real growth line, but it is hitting labor. And of course, inflation would be the other give. So we think this liquidity squeeze will pass as the government opens fully, as quantitative tightening ends, and as interest rates continue to come down in response to weakening employment and inflation indicators that are pointing down.
There is a lot packed into that, so let us slow it down. M2, the broad money supply, is up around 4 to 5% year on year. If the velocity of money is flattening or falling, you cannot keep nominal GDP growing at 5 or 6% forever. Something has to give. Nominal GDP is basically real growth plus inflation. If that headline number drifts toward 3%, you either get weaker growth, lower inflation, or some combination of both. Cathie's point is that the pressure is already showing up in the labor market. ADP data pointing to slower hiring or even contraction. Rising unemployment for new graduates. Longer durations of unemployment across the board. Those are not the kind of signals you see in a red-hot economy that needs tighter and tighter policy. Put simply, she thinks the economy is quietly rolling over, while the Fed is still talking like it is 2022. Why does this matter for us? Because when inflation expectations are back in the 2 to 3% range, growth is slowing, and employment is weakening, keeping policy higher for longer stops looking like prudence and starts looking like a policy mistake. Ending QT is step 1. Cutting rates again is step 2. Easing financial conditions over 2026 is the path that follows if this slowdown continues. And historically, easier financial conditions and falling real yields have been rocket fuel for long-duration risk assets. Growth stocks, yes, but also Bitcoin. Before we get to Ark's Bitcoin model, we need one more piece: how crypto itself is behaving as this liquidity story plays out. The final clip we are using is from later in the webinar, when the conversation shifts to crypto and Bitcoin directly. By this point, they have already talked about Solana, whales taking profits, competition from new chains, and the classic 4-year cycle anxiety. There is a lot of fear about whether this is just another cycle top and whether the bull market is over. Instead of leaning into the drama, Cathie and David step back and look at Bitcoin through Ark's long-term valuation model. They focus on two big changes: stablecoins taking some of the emerging market insurance role they once assigned to Bitcoin, and the gold market cap exploding higher, which increases the potential of Bitcoin as digital gold. Here is how they explain it.
I was on CNBC with Andrew Ross Sorkin and made the comment that compared to our original forecast way back in 2015, 10 years ago, what has happened is that stablecoins are usurping one of the roles we thought that Bitcoin would play, meaning an insurance policy for emerging markets, meaning the individuals in emerging markets whose wealth and purchasing power are destroyed regularly by bad fiscal and monetary policies or by corruption. And that is not happening. However, what is happening at an accelerated rate, interestingly, is the scaling of stablecoins, which I think have scaled to nearly $300 billion. And the other side of that is this has become a natural buyer for U.S. Treasury securities. As China and other countries are diversifying away from the dollar, we've got a big force here, and we think it's only the beginning in the form of stablecoins, which are backed primarily by U.S. Treasury securities. So, David, you might want to take it from here.
Yeah, so basically what we're looking at our model here, just to remind the audience a little bit of what we published earlier in the year. We have 6 main contributors to our Bitcoin price targets. These are institutional investment, which takes as TAM the global market portfolio without gold. Then we have the digital gold, which obviously equates to the gold market cap. We have emerging market safe haven, which equates to emerging market M2 monetary base. We have nation state treasury, corporate treasuries, and what we call Bitcoin on-chain financial services. So a year on after publishing this model, we're focusing on 2 of these buckets that we see as receiving a lot of impact from the markets broadly. One is, as Cathie mentioned, emerging market safe haven, meaning the amount of Bitcoin penetration that could take place in developing nations around the world in order to prevent citizens in those nations from incurring into devaluation or inflation. What we have been noticing is that crypto adoption is wide. It's pretty wide in those nations, but Bitcoin has not taken most of the market share. So going back to a few chain analysis reports, going back to 2024 and so on, they calculate a global market share adoption in terms of transaction volume for Bitcoin of 20% relative to all other crypto, while leaving stable coins between 40 and 50%, depending on the region. So based on that, we basically modified emerging market safe haven and reduced our assumptions, basically multiplying them by 20%. So we cut them into the 20% up into 20% of what they were prior.
So what are they actually saying here? Ark's Bitcoin framework breaks the future into several buckets. Institutional portfolios, where Bitcoin competes for a small slice of global assets. Digital gold, where Bitcoin slowly takes share from a multi-trillion-dollar store of value. Emerging market safe haven, where people use crypto to escape inflation and currency collapse. Nation state and corporate treasuries, and on-chain financial services built around Bitcoin as collateral. 1 year on from their last big update, they have admitted that one of those buckets is not playing out the way they first thought. In emerging markets, people are using crypto, but they are not using Bitcoin as much as Ark expected. Stablecoins have taken a much larger share of transaction volume, so Ark has gone back into the model and cut their emerging market assumptions down toward Bitcoin's actual share of activity, around 20%. On its own, that would drag their long-term target lower. At the same time, the gold market cap has ripped higher. That is important for the digital gold bucket. If the total pool of wealth stored in gold is larger than they assumed, then the upside for Bitcoin as a slice of that pool is also larger. When they run the numbers together, the negative impact from lower emerging market adoption and the positive impact from a bigger gold base roughly offset. The end result is simple. Their long-term bull case for Bitcoin is basically unchanged. So how do you connect all of this as an investor? From Cathie's point of view, we are not in some random environment. We are in a very specific phase, a temporary liquidity squeeze created by QT, TGA dynamics, and higher rates, an economy that is quietly slowing under the surface. A Fed that will eventually be forced into a more dovish stance as inflation and growth cool together, and a Bitcoin that is still early in a long, slow process of being treated as digital gold and a core piece of institutional portfolios. Stablecoins may have stolen some of the original narrative in emerging markets, but the bigger picture has not changed. The financial system is still being rewired, crypto is still the leading edge of that process, and Bitcoin is still Ark's main way to express that bet over the next decade. If you found this breakdown useful, and want more deep dives into how macro, the Fed, and the crypto cycle fit together, make sure you are subscribed so you do not miss the next one. Thanks for watching, and I will see you in the next video.